The most common questions left on our website tend to relate to finance or tax. Well, the content of today's episode of the Michael Yardney podcast has been designed by you as we answer your finance questions. So whether you're a beginning investor or a very experienced investor, you're going to enjoy my chat with Dan Gold, finance strategist, as we answer your questions. And there's one I've thrown in, and I think you'll enjoy the answer because I've heard Dan say you can actually get a finance approval in 2 days. Is this really true? Well, you'll find out in today's episode of the Michael Yardney podcast. So, welcome.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
I'm sure you've heard me say it before, but I'm going to say it again. Property investment's a game of finance with some real estate thrown in the middle. And even though interest rates have dropped and APRA's loosened the screws, I'm still finding investors are having difficulty growing their property portfolio because they're having challenges getting finance. And some of the most common questions left on my property update website and at this podcast as well are about finance. So today, to answer some of your questions, our listeners' questions and the readers of my property update blog questions, I've got with me Dan Gold, Principal of Long Property. Now, Dan's a mortgage broker, but in 2018, he was selected as a finalist in the prestigious MFAA Awards for the Best Young Professional, and he was also recognised by MPA as a top 30 mortgage broker under 35. So welcome, Dan.
Thanks, Michael. That's a very kind introduction. We enjoy the work and the clients are happy. That's the main thing.
Well, now you're going to have to live up to it by answering the questions that some of our followers have left us. So I'd like to run the first one through, which I know is such a common question. People keep asking us about it. But Stephen from Warrigal said that he was interested to understand if buying higher yielding properties in regional Australia, and I guess it makes sense because that's where he was from, would increase his borrowing capacity, and does that allow him to buy more properties?
Yeah, okay, so that's an interesting one, Michael, and thanks, Steve, for the question. In my mind, it's an outdated strategy. The short answer there is that in the current lending environment, high-yielding residential properties do not have a material impact on borrowing capacity, certainly not to the same extent that they did in the past. And the reason for that is that the impact on borrowing capacity from someone's rental income is now a lot less. The banks don't give you as much credit for that as they previously did. And conversely, the impact on taking on new debt is probably now a lot more than what it was when that strategy was more popular. The banks penalize you a lot more and to a greater extent. So the bottom line is that investors lose out there in two ways. That they still hit similar ceilings, Michael, with respect to their borrowing capacity, and the lack of capital growth means that they can often get stuck in terms of being able to grow their portfolios. And as we all know, high-yielding residential properties are often relate to lower quality assets in inferior locations. So it can be very difficult having to save your way to the next deposit if you're looking to grow your portfolio when there's no capital growth. That there's definitely an opportunity cost.
That makes a lot of sense, and I think you know that my strategy has been to buy high-growth properties, and that in my mind, residential real estate's a high-growth, relatively lower-yield investment. And yeah, of course, I can understand why people think, well, if I get a bit more cash flow, that'll make a difference. But it's now these new, much tougher serviceability criteria. They're looking at other things, Dan, aren't they? So what are the priorities the banks are looking for?
The rental income is only one of many factors that dictate somebody's borrowing capacity. And to be perfectly honest, if the strategy is to increase your borrowing capacity, there are so many better ways to do that. For example, depending on somebody's circumstances, there might just be a different lender that can interpret somebody's income or expense profile in a totally different way, and that could play a significant factor. Another one which is very topical at the moment is living expenses, and to the extent that somebody can, even if it's just for, say, 3 or 4 months leading up to an application, perhaps reduce some of their discretionary living expenses, that could have a far bigger impact on someone's borrowing capacity than the rental income, which actually hurts because the banks are only now accepting maybe 75 or 80% of that rental income anyway when they do their calculations. And they also just assume now that you're going to have a lot more expenses associated with just running your property, given that you have added another investment property, which let's face it, does have costs associated with it to your overall portfolio.
Well, that's, I think, one thing that many beginning investors don't realise, that the banks don't take all your income as income. So sometimes they don't take into account bonuses you get or special bits of your salary. And they also don't take into account 100% of your rental income, or some banks don't. And as you clearly say, a part of that is because there are outgoings. So they're being more careful about what cash you really have to service your loans. Now, I'd like to follow up with something you just mentioned, though, and that's discretionary spending. They are looking more carefully at whether you go to the movies and buy tickets on your credit card more often, or go on Uber Eats or eat out 3 or 4 nights a week. So your hint was be careful and be prepared in advance. Is that correct?
No question. Be careful and be prepared in advance. But at the end of the day, I think in particular nowadays, post-Royal Commission, the pressure's perhaps off slightly in comparison to when in particular the big banks were just under the spotlight with the Royal Commission ongoing. The banks are generally pretty reasonable and understanding about this. I think one of the key messages that I'd mention here is make sure you're just working with a good banker or broker that can help explain your situation to a bank carefully. It's one thing if you've just gone on 2 overseas holidays in the last 2 months. The bank's not necessarily going to penalise you for that if it can be properly explained that, maybe that was one-off and entirely discretionary, or maybe it related to a work trip, for example, which has nothing to do with your own personal living expenses. And that's just one example of many. So if it's positioned correctly and it makes sense and you're not, significantly below the types of averages that the bank would be expecting for borrowers of your kind of income profile and family makeup, then it's generally more complex than just showing low living expenses on a bank statement for the last few months.
All the more reason today to have a finance strategist like you on the side. Now, some people are going to say, Dan's got a vested interest, saying get somebody to try and help you get through the maze of loans. But if you go to one bank, their criteria could be quite different at looking at postcodes or looking at how your particular income, if you're self-employed, is assessed compared to another bank, Dan.
Yeah, absolutely. And, that actually just leads me to 2 quick points. The first was just maybe to end that discussion on Steve's question, Michael. The idea around high-yielding investment properties is different depending on who you are as an investor. And the reason I say this is it because it also relates to, just this idea of whether or not interest rate is the be-all and end-all of your borrowing strategy. Younger investors are typically those, Michael, that are taking on more leverage, and they're the ones that are tend to be more interested in a high income earning investment that can improve their borrowing capacity. What we find, though, is that because those younger investors are taking on more leverage, they're the ones that get penalized by these assessment calculators more than, say, established investors that are investing in commercial property. They've got totally different needs and objectives. The bank's assessment methodology for commercial investors is entirely different. And that's when I suppose yield could be more important. Bringing it back to, Michael, your second question there around working with good bankers or brokers. Yeah, absolutely. A different bank could interpret your situation differently and help you in many ways that another bank can't. And I suppose that maybe just the point I'm trying to make is that younger investors don't necessarily realize the complexity of lending, and they just might think that it is as simple as finding a cheap rate, and that's that might be counterproductive.
Well, that actually is one of the other questions I've got for you, so we can talk about what you look for in a loan in a moment. But I think your point a moment ago is worth repeating, that it depends what level, what part of the journey of your investment journey you're on. So I know we work together with our clients, you work with a lot of our clients, and when they're more established and they've already built a substantial asset base, we start to recommend transitioning to cash flow investments as they start to lower their loan to value ratios. But for those, we tend to look at commercial properties, offices, shops, warehouses, as opposed to regional properties. So again, you've still got to have a good asset. But if I could throw in one other bit for Steve, and I know you're aware of it because of the things that you're doing with your own personal investments, Dan, there is a way of getting a combination of high growth and high yield or higher yield. And that's to increase the yield, to manufacture some yield by doing renovations on your property, and that will actually improve them and get you higher rents. Or, one of my preferred strategies, and I know you're doing it also, Dan, is actually doing a development. Now, that's not for everybody, and you need a lot more money and you need a lot more experience, but there are ways for sophisticated investors to get a combination of good growth and a high yield, and the banks love that too, don't they?
Yeah, well, I think the key point there is that by following that strategy, which we do see more frequently with people earlier in their property journeys, is that you don't have to sacrifice on the quality of the assets in your portfolio. And therefore, you're really getting the best of both worlds. You can, like you say, manufacture the improved cash flow, but you can also have assets in your portfolio that are more likely to outperform averages over the longer term, and that's going to build your equity position, which will give you more optionality in the future.
Okay, well, thanks for answering Steve's question. Now, Valerie from Beaumaris, I think it's Victoria, sent a question in, and it was, what factors should I look at other than interest rates when I'm looking to get a loan for my next investment property? So, Dan, in your mind, what are the non-negotiables? Because I know in our previous conversations, we've agreed that while interest rates are interesting, they're probably not the most important factor at all, are they?
Yeah, well, absolutely not. And it's funny because, again, it's a lot of the first home buyers that do seem to be more fixated on interest rate. And it's the more seasoned investors that are less so. And maybe that's a bit counterintuitive in a sense, because it's the more seasoned investors that tend to have more debt. So you'd think that they're more exposed and hence more interested in interest rates. It's not the case at all. And again, it just comes down to understanding the complexity behind lending and what other factors are important. So I guess specifically to answer Valerie's question, there are two things I'd focus on. The first is you really just need to find a lender that can actually meet your requirements and objectives. And the second thing is that you do have to be selective with the person or group or bank that's going to be taking you through the process. So would you like me to elaborate, Michael, on those 2 points for Valerie?
I think so. Yes, let's work through it in a bit of detail, please, Dan.
Sure. So with respect to the first point, finding the right lender, if it's just about interest rate, there's only a very small number of clients who have the most simplistic requirements that these cheapest rate kind of lenders might actually be suitable for. So I'll give you a couple of examples. There's no point just Googling the cheapest home loan rate, only then to realize that it only is relevant for, say, a PAYG applicant with a low loan ratio, maybe 70% or less. And meanwhile, you've got very complicated self-employed income and you require maybe 80 or 85% gearing. So it's a knockout, right? Or if your strategy relies on using maybe an offset account or interest-only repayments to, say, improve your cash flow or to preserve the deductibility of debt, the cheap interest rate isn't going to allow you to do any of that because it's a feature-light loan product, and therefore it's really just a waste of time. A couple of other examples come to mind around, like, say, speed and service. So if you've got a 30-day purchase settlement, there's no point going to a lender that's going to take 2 weeks to assess your application and then another 2 weeks to approve it and maybe a few weeks after that to actually administer it. And you'd be surprised, Valerie, if you are listening to this, just the difference in service and speed between different lenders. If you chose the wrong one there, you'd be getting very stressed through your acquisition process and potentially encountering a lot of unanticipated fees and penalties. And then the obvious one we touched on earlier, Michael, is borrowing capacity. If you need 700,000, but this cheap lender can only give you 600,000 because of their more limited policy, they're not going to be a suitable lender for you, and you wouldn't mind paying an extra 30 or 40 bucks a month to get the additional borrowing.
Well, Dan, that makes sense, but it's not the way many people think. I remember only last week somebody suggesting to me he was actually stuck getting, it was finance for a development, and he had to go to what you and I would consider a second-tier lender, but somebody very safe, and he'd have to pay 1% more interest or 1.5%. It was for the year of development, the development process, and he wasn't prepared. He was being, let's be blunt, stingy and not prepared to pay the extra, a little amount in interest, which interestingly is tax deductible for him, and he wasn't going ahead with the project. And I said, mate, look, back. I'd rather pay that extra and make the money and do the development and get ahead and be ready at this as the cycle moves forward. Not everybody thinks as rationally as that. We get a bit emotional when interest rates are there or fees. And again, they're not as important. So what is important?
Yeah. So I think that the way I tend to approach it with clients is, first and foremost, we've got to find, obviously, a suitable lender. But before getting that specific, you might like to think about it in terms of, the different types of lenders that are out there. So with that example that you just gave there, Michael, it sounds like maybe the lending options were more limited, and this client, if they were going to proceed with the strategy, was maybe limited to one of the smaller non-bank lenders, right?
Exactly right.
If we get that far, then it's not even, first you've got to determine, all right, if we're going to be siloed into that basket of lenders, are you still comfortable with the overall strategy for the types of reasons that you've just described? But then I don't like getting too granular in terms of, to the extent that it's not necessary, which specific non-bank lender within the mix of non-bank lenders is the best, because often their offerings tend to be relatively similar. And if you look at the major banks and stack them up between one another, CBA and NAB and ANZ and Westpac, they're also going to be reasonably similar, give or take, a few things here and there and maybe 5 basis points, right? So at the end of the day, again, this is the second point that I wanted to make around what's important for people to consider when choosing their bank is, who is going to be the person that's actually taking you through this process, right? Because if on the margin, the small banks are similar to one another and same with the big banks, at the end of the day, you've got somebody who's going to be taking on all of your information and supporting documentation, collating it all together, writing a credit memorandum, lodging it to the bank, answering the 100 questions that you've got throughout the process, keeping you up to date, securing a positive outcome with the lender, and then obviously seeing it all the way through to a settlement. And, you're either going to be dealing with someone through that process that is new to the game and is inexperienced and is unreliable and doesn't have the capacity to kind of meet your service expectations, or there's going to be somebody, that's the opposite on each one of those points. They've got a high personal work ethic, very experienced, they know what they're doing, they've got all the right systems and processes and support to just make sure that your experience on all those levels is positive. And at the end of the day, would you pay, 20 or 30 bucks more a month for all of those things? Of course you would. And it's not even to say that you can't get a great rate with these good operators. Absolutely you will. But, at the end of the day, if it is, a few dollars here and there, it's kind of immaterial in the grand scheme of things.
It's because getting a loan today is such a much more complicated, difficult, time-consuming process. So it's great to have professionals who now protect home buyers and investors and level the playing field. And that's why we have almost gotten to the point now at Metropole where we say to our clients, if you come along with your own broker, if you go into your own bank, we're not prepared to work with you. Now, that's not arrogant. It's just, Dan, every time something goes wrong with a settlement or not enough money there or not enough there, they haven't thought of all the contingencies, it's when somebody's gone to their own broker or an inexperienced broker and gone with a cheap loan. Now, I'm not saying every time they go to their own broker, they get it wrong. I'm just saying whenever things go wrong, they've gone to their own broker who doesn't understand the process properly. So I think you made a good point there. Now, Dan, there's a question from Ian from Brighton Le Sands who asks, are interest interest-only loans back? And it's a simple question, but I know that investors love interest-only loans because it preserves their cash flow. And I know recently it's been much harder. There's been a lot of talk about the banks twisting us round to principal and interest loans. So how do we answer Ian's question, interest-only loans back?
Yeah, so the short answer is that for the right borrower, interest-only loans never really went away. Even when APRA did implement that regulatory change a couple of years ago, interest-only loans were still absolutely available to the right borrower where it made sense, and the bank understood that. But notwithstanding, there were, as I'm sure many of your listeners would be well aware, Michael, there were some significant changes that were introduced a couple of years ago. And it was really APRA with the intention to just slow down, in particular, the Melbourne and Sydney property markets, in 16, 17, that were really in that boom phase of their cycle. And in particular, where investors were fueling a lot of that growth. At the time, the proportion of interest-only loans in the marketplace was about 45% of all new loans. APRA felt that a 30% ceiling was more than adequate. So, that's the time when we saw policies tightening on interest-only lending, sure, but also that price differential that you alluded to. So all of a sudden, the interest-only loans did become more expensive, and that meant that a lot of clients preferred principal and interest to secure the cheaper rates. What we've seen now is that APRA has since removed that 30% ceiling, and therefore there is absolutely more discretion now that the banks do have to offer interest-only products. We still have to position it carefully, but A, they're more open to it, and B, we're actually seeing that pricing differential lessen a bit for the same reason. The banks can do more interest-only loans. They're looking for strategies to kind of rebuild maybe some market share that they lost through all the turmoil over the last couple of years in residential lending. And by offering some very attractive interest-only rates, that's incentivizing a lot of clients to come back to those lenders.
When I first started investing as an investor, my mortgage rate was always higher than the home loan rate. And then during the heady days of easy lending, they dropped that differential. And more recently, investors are paying more than homeowners for their loans. What's the position at the moment?
Yeah, so that's right. I mean, when I suppose these first changes were introduced, it was not uncommon to see that interest-only loans may have been around 50 basis points or thereabouts higher than principal and interest loans. And similarly, investment loans may have been 30 to 40 basis points higher than home loans as well. So the difference between a P&I owner-occ borrower versus an investment interest-only borrower could have been upwards of 80 or 90 basis points, even higher. What we're seeing now, particularly with some of this new aggressive interest-only pricing that the banks have introduced, is that it may be that differential is only 20 or 30 basis points now. So obviously that's lender specific and there are promotions involved and whatnot, which aren't always available, but that's definitely enticing a lot of people back into the interest-only segment. The banks are supportive of it if it makes sense. And ultimately it's helping people with cash flow, which may just give them the confidence to take on that next investment property. And I guess that is the intention of APRA removing the 30% quota, is to encourage some investors back into the market. And perhaps now that we're transitioning from, that growth phase of the property cycle to a contraction phase, which is obviously arguably bottoming or bottomed out now. But, the intention was always just to stabilize and steady that contraction as opposed to, wiping every investor out of the market such that contraction phase could have been more dramatic and impactful.
Another question that's come now from Brian from Brighton Le Sands in New South Wales is, how do I release the equity from my property portfolio? I guess what he's asking is, now that my properties have gone up in value, and well done, Brian, that they have, how does he get it? Are the banks willing to lend against it?
Yeah, absolutely. Releasing equity from somebody's portfolio is a relatively straightforward exercise. I suppose not everyone does realize that they can do it, And then the second point would be that not everybody realizes how best they might be able to do it, right? Point number one is just a review of your property portfolio. Looking at your lending and looking at the value of your properties may give you a sense as to how much equity you've got in your existing assets. Okay, point number one. And generally speaking, the banks allow you to borrow, to keep things simple, up to 80% against any one of those assets. So say you're, for example, only leveraged at 50%, it might be that you could release that additional 30%, and that 30% could be more than adequate to fund the deposit and purchase costs of your next property. So the relevant way to do it would be approaching a good banker or broker and just running through those numbers. So if you were going to, say, use your equity to buy another property, what are the overall amount of costs that you would need? And then what's going to be your funding mix? What percentage of debt finance would you like to contribute versus what percentage of cash? Often for investors, it's a higher level of gearing that they'd like, because that means that they can preserve more of their cash to reduce their home loan debt, which is the non-tax deductible debt at the moment. To the extent that you're comfortable with what the repayments look like on the additional leverage, releasing that 30% equity to cover your deposit and costs could be a good strategy.
So are the banks open for business? I guess that's what he's asking in between. If you read in between the lines, I think most people who listen to this podcast, one of my blogs, understand the principles, but I really appreciate you've gone through those again, because people sort of forget that that's their asset that they can borrow against. So yes, see what your loan to value ratios are. Also see, are your current loans appropriate for today's marketplace? And can you maybe even save a little bit in interest by just asking? But are the banks interested?
Yeah, so I think like with so many residential borrowing type scenarios, it often comes down to two things: the equity and the serviceability. And we just discussed what the equity situation looks like. And the short answer is absolutely the bank would be open for business with respect to helping finance that second investment property, the investment property, so long as the borrower can demonstrate sufficient serviceability to take it on. There are two things there. One is the actual, serviceability calculators that the banks use, and then secondly, it is also very important that the banker or broker just discusses exactly what the running costs of a new asset in someone's portfolio means in practice, because often there can be a disparity between what the bank calculators say and what it means for you in real life. Just the last point, Michael, if I could make there for Brian, would be just be careful about how this type of scenario is structured. Whenever you take on a new asset, particularly if you now have deductible versus non-deductible debt, the way you structure that is so important. And one of the key mistakes that I think people often make, and they only realize it later on, is that this is where it can be very important not to cross-collateralize any of your lending. But often that's what the banks want you to do because it gives them more power and control, but it can also limit your flexibility with what you can do with either of your assets in the future, as it relates to maybe refinancing or selling those properties. So our advice, by and large, for most clients is to not cross-collateralize and to keep all lending isolated to the asset that it's secured by only.
So to make it clear, I think what you were getting at is if it's his home, that's the asset with the extra equity, he wouldn't actually be upgrading his home loan because that would not be non-tax deductible debt. Or on the other hand, you can take a separate loan against the same asset. And that would then become your deposit. And that purpose of the loan is what makes it tax deductible. The purpose is as a deposit for the next property as opposed to the asset it's borrowed against, even though that's his home. The borrowing for the purpose of an investment is tax deductible. But the cross-collateralization thing is clearly an important factor. And I know some people poo-pah that, but I've seen, and I'm sure in your experience, because you deal with it all the time, you've seen how it can hamper you down the track. But you can, if I'm not mistaken, Dan, have loans even with the same bank, but they don't necessarily have to be cross-collateralized.
Yeah, that's right. You absolutely do not need to cross-collateralize your lending. By and large, unless you're a very sophisticated investor with upwards of 10, 15, 20 properties. My experience has been that ultimately the banks are very comfortable with clients not cross-collateralizing. It just gives them more flexibility, because at the end of the day, if you just release that equity, say against the home in Brian's scenario by itself, then really it's entirely up to you where you go and finance, say, the 80% loan to acquire the new property. You might do that at your existing lender, which is fine. It still does not have to be cross-collateralized there. Or you've got the ability to go and finance that 80% at any other lender that's open for business as well. And there can be advantages associated with keeping it separate. For example, you might in the future decide to sell one of those two properties, and it just means that you don't then have to go and revalue the rest of your portfolio. Also, the banks just kind of stay out of your way with respect to potentially redoing assessment metrics and things like that. If, for example, you were to sell your investment property and now forgo the rental income, you just don't want it all tied together because the banks can get in the way.
Well, you're staying under their radar. Now, Dan, we mentioned the term cross-collateralization, I can't even say it sometimes, quite a few times. And there may be just one or two people listening to this who aren't fully familiar with what that means. So can you please explain it?
Yeah, sure. Well, maybe the simplest way is just with reference to Brian's situation there. But let's say that Brian has a property that's worth $1 million and he's got a $500,000 loan. He's now going to buy a new property, which, I don't know, let's say that's worth $500,000 plus costs. He could just go to that existing lender and get one new loan for $550,000, but that new loan for $550,000 is going to be secured by not only the new property, but also the existing property. So it's secured by both of his properties, and that's what we mean by cross-collateralization. You could never go and get a $550,000 loan against the new property only, because the gearing ratio would be 110% or higher. So the way that would be structured, if it were not cross-collateralized, would be that you just get, say, a $400,000 loan against the new property by itself at a loan ratio of 80%, and then the remaining $125,000, $150,000 to complete the purchase, that is your investment loan secured by the principal place of residence that Brian owns.
Thank you for going to such detail. Now, I've got a question from me rather than just from the listeners, because I've heard you say that you can get a loan approved within a couple of days. And I'm wondering, is that really true? Because I keep hearing that it takes weeks and weeks. So I've seen you speak about that, read it in your blogs. Explain what's going on, Dan.
Yeah, no problem. So it almost sounds like a bit of a fancy marketing type thing, doesn't it? Get a 2-day loan approved. but I think that what we need to realize is that often the people that you hear, let's say, Michael, complaining about the loan that takes several weeks or even months to approve is because it was such a bad experience. Often it's the people that get their loans approved quickly and have a good experience that you don't hear about because they're happy. Absolutely, there are lenders in the current marketplace that can turn around applications quickly, and we love using them because ultimately it helps us deliver clients a good experience. Nobody wants to take several weeks or months to go through this process. So I guess, Michael, there are certainly a couple of tips, for lack of a better word, that can help guide people in that direction. Would you like me to maybe just discuss them in a bit more detail?
Yes, please. I bet you everyone wants to know, how do I get a loan in 2 days? So you've got us sitting here wondering.
Yeah, sure. All right. So I guess first and foremost, obviously you need to deal with a bank that's capable of doing it, because whilst there are some that can, there are many that still can't. So, if you're in that latter category, irrespective of any of these tips that I discuss, it's going to be a futile exercise. But if you have found a good lender that has the capacity and the systems and processes and staff ultimately to do this quickly, then it's a great starting point. Secondly, you really just need to make sure that you've got 100% of your required documentation up front because incomplete applications cannot move quickly through any system. The banks don't budge on that, and they're very vigilant. So if you just kind of think for convenience that you want to cut a few corners, no, there are no shortcuts. It won't work. Okay. Secondly, if there is any level of complexity with respect to what you're trying to do, based on maybe the lender understanding how your income works or certain maybe commitments or liabilities that you've got, I highly recommend discussing these areas of complexity up front with the bank and the relevant people in the bank prior to lodging any applications. Because if there is something that is uncertain and hasn't been clarified up front, 9 times out of 10, you're just going to get somebody from the assessment team at the bank that comes back and asks more questions, asks for more documentation, clarifications, etc. And that's always the thing that we see slow down the process, because ultimately when you respond, not only does it take a few days to respond, but often your application just gets into the bottom of the queue again, and it takes a long time for the assessment to pick it back up.
Now, Dan, that's clearly where it's useful having somebody like a finance strategist such as yourself on your side, because half the time, as a borrower, I don't know what the bank wants or what they would see as unusual, but you're dealing with this every day.
I actually think it's one of the best parts of an experienced operator's value proposition. Not only they're doing it every day, but if you're very active in the marketplace, you've got a strong kind of policy knowledge, which bank can do what and how they interpret things, not just in the past, but as at today. Because, Michael, all of these policies can literally be changed on a weekly or fortnightly basis. So it goes without saying that it's critical. And just a couple last points, Michael, I'd say that, it's important to submit a quality application. I guess it does actually speak to, similar types of things that we've both just spoken about. You obviously need to collate the right information and then explain it appropriately to the banks. And if you've got a sense as to what the banks look for, what questions they typically have, it goes without saying that if you can just answer them up front, it's so much easier for the assessor to just accept that and tick the box and move on, as opposed to delaying the process. So, high level, I think they're probably the key starting points. And one last thing, maybe we've dealt with clients recently that literally have upwards of 20 loans and 20 different properties. That's not the kind of loan, unfortunately, that's going to be approved in 2 days. That's going to obviously take a bit longer.
Well, there we go. A whole lot of questions, some really good answers, bringing some simplicity to the complex world of property finance. Dan, your details are going to be in the show notes, and I know you write blogs on Property Update. There was a good one we published just a couple of days ago. But if people want to find out more about how to beat the banks and get them to say yes more often, how do they contact you?
Yeah, look, that's very kind of you. We're just at longproperty.com.au. So anyone that's interested in more information on finance and lending, happy to help. Or even just speak to the guys at Metropole. Often they're referring their clients to good lending strategists and good mortgage brokers. So that's also a good starting point as well.
Well, I think people can hear from what you've presented why we're very comfortable working with you and your team. Thank you very much, Dan Gold from Long Property. I look forward to having you on the Michael Yardney podcast again and answering some more listener questions.
Yeah, thanks again, Michael. Appreciate your time, and thanks to everyone for listening.
Thanks for staying with us for this slightly longer podcast, but it was dictated by the questions you asked, and I love getting questions, so leave them at michaelyardneypodcast.com or my Property Update website. Now, in between these twice a week podcasts, I hope you're getting my Property Update newsletter, where you get a lot of information from a range of experts about property, about tax, about finances, about success, about money. And if you enjoyed today's show, please tell somebody else about it, because just like I'm trying to help you become more proficient with finance and more successful and financially fluent, I'd like us together to get the message out to as many people as possible. So there's usually a share button at the bottom of every podcast app, or just tell somebody about it on Tweet or Facebook, because I'd like to build the community. It's growing amazingly, but I'd like to help as many people as possible, as I said. I'll be back again real soon, because I bring you these podcasts twice a week. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?